Okay, hi, welcome back. Okay, so this is part 2B of the revision series on investments. So I'm Will Dicha and welcome to my YouTube channel, right? So part 2B is where we are going to continue from, right? So earlier on in the previous video we talked a little bit about equity investments, bond investments, and now we are on to warrants, right? Now, a warrant is also another type of investment, also accessible to not just businesses but individuals. A warrant basically is a stock option. Now, this option is quite powerful. This option allows the bearer of the warrant to have the ability to buy a share at certain predetermined prices within a certain period of time. The benefit is that it allows the warrant holder to exercise the share option or exercise the option when the price of the share is attractive, right? Of course, if the share prices are not attractive enough, the warrant investor may choose not to exercise at all, right? Now, the warrant upon expiry has no value at all. So this is one issue, it has no value. Right, it is traded in the markets and it is normally attached with another financial instrument. So it could be attached to something like, let's say, a bond, right? For example. So that's warrant. Now, and we move on to commercial paper. Commercial paper is quite interesting. Commercial paper is unsecured, it's issued by corporates, and it matures within a short period of time, right? And of course there is some degree of default risk. Given that commercial paper is still a form of borrowing, so therefore default risk is still present. It is typically traded in money market due to the fact that it will mature in very short periods of time. Okay, so next is the certificate of deposit. Basically, certificate of deposit is one which is issued by a building society or a bank. And because it's issued by a bank or building society, it is generally quite low risk. There is almost no risk that banks will collapse unless the bank happens to be in serious financial difficulties. Right. Certificate of deposit offers low rate of return, right, and the maturity varies, 7 days until up to 5 years, right. It can be traded in the money market, and it's traded in the money market at a discount. Right, so that's a certificate of deposit. Certificate of deposit is also highly liquid. So it is quite easy to convert your certificate of deposit into cash quite readily due to the amount of liquidity that it enjoys. Okay, bill of exchange, right, a very simple form of investment. Basically, it is a promissory note. It is an unconditional order by the drawer, right? This drawer may be a supplier, depending, and the drawee may be the customer. So such a bill of exchange may be a demand for from the supplier to the customer to make payment. So customer has to make payment, right? Okay, so it is possible that the payment may not necessarily be payable back to the drawer. It may be payable to some other drawee, depending, right? The bill of exchange can be classified into two types. The term bill. Now, term bill is one where payment can only be requested, or if you like, ordered, only after a certain number of days or only after a certain time period. A side bill allows immediate payment. So the moment when this side bill is presented, immediate payment can be called for. Right, the bill of exchange has the liquidity of this bill of exchange also depends very much on credit quality of the drawee. So obviously, if the customer or the drawee has past history of difficulty in paying up, then the liquidity might not be as good. Usually traded in money markets, quite simple. Local authority stock, right? This is issued by the local authority. This is more relating to the UK. Now the features of local authority stock is that this is normally traded in the money market, right? Liquidity is not as good as those issued by the central government, okay, and obviously it faces some degree, some extent of default risk. Okay, so these instruments that you saw just now, they have to be traded in financial markets. Why? Because financial markets provide liquidity. It makes it easy for investors of securities to be able to sell. Makes it easy for interested investors to be able to buy. Right? Liquidity makes it possible to trade and also makes an investment attractive to investors. An example of an asset that is highly liquid is gold. Gold is extremely liquid. Have you realized that is also why older people are preferring to keep this type of asset? Right? Because gold is just very liquid. When you need, you could bring the gold to a pawn shop and you still can sell and recover most of your principal, or even get back more. Right. Financial markets also exist for the trading of many other types of securities, including, as I mentioned just now, shares, bonds, and then commercial paper and so on, including options and futures. And each type of security would match the risk appetites of different investors, right? So all the securities have to be issued first new, right, in the primary market, and then of course once they are traded, they are issued new, then they are traded in the secondary market. Secondary market is important because, as I mentioned to you before, it makes it possible for investors to be able to trade their investments, and they are able to balance their portfolio so as to make sure that the portfolios match their risk appetites. Securities also gain much more liquidity when there is a secondary market, and that makes the investment much more attractive to investors. Right. So each of these security differ mainly in four aspects: liquidity, maturity, return, and risk. Right. And the same also applies to basically all kinds of investments, not just those that I've listed. Right. Each instrument essentially fits the investors of different risk appetites. So no one investment would cater to whatever needs of the individual. Right. So with that, thank you for watching, and I'm Wordy Chia, and you have been watching this video on my YouTube channel. Thank you for watching. Have a great day.